Some senators are urging the biggest banks to scrap or reduce overdraft fees. They're calling for a more fair fee structure, citing research that shows nearly 80% of fees hit just 9% of accounts. This Monday, our financial expert Paul Hood is here to break down overdraft fees and what this could mean for your bank account. Paul, always good to see you. Let's jump right into it. What do banks get from overdraft fees, and how would cutting or reducing them impact those who have an account?
So overdraft fees are really designed to be punitive in nature. You know, they're if you write overdraft $100 and they charge you $25, well, that's 25% interest for that 1 or 2 days. It's huge amounts. So there's a lot that banks can do to make that more fair. Now, do we want them to do that, Brian? You know, I'm kind of always thinking outside the box, and you always have to see, what are we encouraging? You know, we're encouraging people to live outside their means. So sometimes that punitive nature of the overdraft fees is a positive thing, because it's a, you know, you grow and learn from the carrot, you know, and the stick. And so that overdraft fees are the stick. So do we want to take the stick away? Is that going to encourage more bad behavior? So I don't really know how that'll turn out.
Keep an eye on it.
Yeah.
We have a couple great viewer questions. Let's jump right in with Eric's. Eric says, I own a piece of property jointly with a friend. We purchased it 50-50, the total mortgage interest nearly $14 million. He's already recorded his half of it on his tax return. Do I need to claim half of that amount on my return as well?
So yeah, one of the things that I would look at is this an actual entity that's set up, or the IRS allows for what's called a joint venture. Now, joint ventures are where a business property or rental property is owned by more than one unrelated person, or not husband and wife. The IRS generally doesn't like long-term joint ventures because of situations like this. So the reality is, what they should do is form an entity, an LLC or something, that owns that. So then the mortgage interest would be deducted on the business return, and then they would get their proportionate share. So in this case, though, yeah, they can go ahead and deduct their half, but if they get called on the carpet, get audited, oftentimes it's difficult to prove, hey, I paid that half. Just because he owns half of the building doesn't mean he gets half of the interest. They're going to look at who pays it.
All right, to Renee we go. Renee says, my daughter worked at Papa Murphy's for a few weeks last year, but hasn't received a W-2. The company is not helping her get one. That's interesting. She made roughly $2,000, but never received pay stubs, so they're not sure. I'm claiming my daughter's a dependent, and I'm not sure how to handle this. What advice do we have for Renee?
So I get this question a lot. There is this thought process that if I claim my kids and they have a part-time job, somehow I've got to pick up that income on my tax return, and that's not the case. Your children are an independent, separate taxpayer. And so if they earn income, then they have to file a tax return potentially. If their income is not over $12,000, then they're not going to owe any taxes. So Renee can claim her son regardless of the $2,000. Now, and the son really has no filing requirement whatsoever, because he can earn up to $12,000 without paying any taxes. Now, one piece of advice: if you've got kids that are going to earn less than $12,000 and they're students, they can file exempt on their W-4, and they won't take out any taxes. Then they don't have to waste the time to file a tax return.
All right, good stuff, Paul. Always great to see you. Thank you. And if you have a financial question you want us to talk about next Monday, you can send in your question right now, just like those folks did by email to moneymonday@griffin.news.